Welcome back. New data on U.S. inflation is now 17 minutes away. The market is expecting to hear that inflation grew in May at an annualized pace of 4.1%. That would be down significantly from the 4.9% reported in April. This all could play into what the U.S. Federal Reserve Board announces tomorrow at 2 p.m. Eastern Time when it makes its next rate announcement. Our next guest, believes the Fed is near the end of its rate hiking cycle. For more, let's bring in our featured guest of the morning. He's Jeff Weniger, head of equity strategy at WisdomTree Asset Management. Jeff, first of all, thanks a great deal for joining us. You've given us a lot to talk about this morning, and let's begin with the inflation numbers. Why do you believe, Jeff, that the U.S. Fed is close to the end of its rate hiking cycle, and what do you believe the Fed will announce tomorrow?
Well, unfortunately, I don't know that I can give you much more than street consensus on the action tomorrow. I know that what I would do is pause. I mean, this has been one of the most aggressive tightening cycles that many of us have seen. I mean, Paul, they've only been doing this for 15 months. They already gave us 500 basis points. I think at some point you have to take a breather and say, let's just sit back and see what we've done. What will be the lagged effect of all of this? And yeah, the timing is going to work out in a peculiar manner because we have the CPI number coming in 10 or 15 minutes. Look, you said 4.1 year over year. If it's 4.1, 4.2, that should be probably the type of number that the market wouldn't react too boldly to today. But I think you got to look inside the report, specifically at the housing information, both owner's equivalent rent and rent, to try to get a feel for just how poorly calculated this number is, Paul. It's still going to show high single-digit rent inflation in the United States, which is not the reality on the ground. Rent is in deflation in the United States. It's going to show home price appreciation. Again, that is not the reality on the ground. Home prices are going down, generally speaking, across the U.S. So it will say a 4, theoretically. We'll see what happens. But chances are, really think about it, they're close to in real life terms at this point.
You think the report will be wrong on real estate prices, do you?
The report is wrong. The report is wrong. That's the situation on the way up, where we saw, I mean, everything that we saw during COVID was just so preposterous with the U.S. housing market, and the report needed to capture all of that data with a 12 to 18 month lag. And yet, look at the Redfin numbers. I mean, let's just look at them. I mean, they're saying that home prices in the U.S. are down 4% year over year. That's the reality on the ground, and rents are ever so slightly down in the United States. But when we get this report, not looking at my watch right now, but 15 minutes or so, something like that from now, open it up, and it's going to show rents up year over year in the high single digits. That is not the situation, because it is still capturing the old 2021 and 2022 data. That is the way the CPI report functions. So it's one of those funky macro reports. It's probably the worst calculation in all of macro, and so we have to take it with a little bit of grain of salt.
Okay, let's move on to the markets. Of course, the inflation numbers could be felt in a big way in the markets if they are outside of consensus. A lot gets talked about these days, Jeff, about the lack of breadth in the market, and we hear over and over again that the S&P 500 has been led higher by essentially 7 large cap stocks. You think that story is starting to change, and we've got a graphic here that we can bring up on the screen and have you talk to it. The white line is the S&P 500 index, up about 14% so far this year. This is a year-to-date graph showing 2023 so far this year. The blue line is the S&P 500 equal-weighted index. So those big 7 stocks have the same footprint as every other stock in the blue line. And what is significant, I think you're going to tell us, is the uptick in that blue line over the course of the past several weeks.
Yeah, and I'm simulcasting in, so I can't see the image, but I can picture it in my head because it's been making its rounds so much, Paul. And that was, the issue whether it was 7 stocks, 6 stocks, 8 stocks, but basically, let's say it's 7. The wrap on this market up until, let's call it the last week of May or so, was that what about the other 493 inside the S&P 500? They were by and large, not participating. This was levitating higher on account of the Silicon Valley rise. There were several things going on there, Paul, and it made some intuitive sense. Remember, up until when? Just a few weeks ago, the debt ceiling was either issue number one or issue number two. Whether regional banks was a bigger thing in your own mind is something we would debate. But the U.S. debt ceiling was the big issue, and there was this mentality in the system of, well, what am I going to do with my money? I don't even know if I'm going to get paid on these T-bills. Tell you what, I'll park it over here at Microsoft or Apple and just sit out the rest of the spring. And that was essentially what levitated the top of the mega cap spectrum in recent weeks. Well, that kind of came to pass, and so now we got more of this rotation. You're presenting the equal weighted 500. The Russell 2000, which is the index of U.S. small caps, that is now making a move. The regional banks are back on, or at least catching a bid. And so that is one of those things that the bulls should be grasping on. It is on net something that is healthy. We don't want to make big hay out of something that's been going on for only 2 weeks or so. But the wrap on this market for a while was just these half dozen names. Now we have some broader participation. It is, generally speaking, that much more bullish for the broad market.